So imagine this. Two companies can have the exact same stock price, but entirely different risk levels. You could be looking at a rock-solid titan of industry on one hand, or a wildly unpredictable startup on the other, and the share price alone won't tell you which is which. The real difference, the metric that Wall Street actually relies on to classify these companies instantly, is something most everyday investors completely ignore.
Let's really dive into this. Picture two stocks. Both are sitting there, priced at exactly $100 a share. To a beginner, these look like identical commitments of capital, right? But the first one could be a rock-solid, stable giant, a safe haven anchoring a retirement portfolio. The other one? A volatile startup, a wild gamble that might double overnight or literally drop to zero by next week. The secret to telling them apart isn't the price tag at all. It's market capitalization. In this explainer, we're going to quickly walk through the market cap formula, the stability of large caps, the growth of mid caps, and the wild ride of small caps. Then we'll uncover a massive valuation gulf happening right now and wrap up with some actionable strategy. By the end, you'll understand exactly how the pros instantly flag a stock as a safe bet, a risky play, or an explosive growth opportunity.
All right, part one. What exactly is market capitalization? And what's the formula for size?
Market capitalization, or just market cap for short, is the total value of all a public company's outstanding shares. The formula is incredibly simple. You just multiply the share price by the shares outstanding. So, if a company has 1 million shares and they trade at $100 each, boom, the market cap is $100 million. This is exactly why looking at a stock's price alone is super misleading. Think of it like a pie. A single slice of pie doesn't tell you how big the whole dessert is unless you know how many slices there are in total. Market cap tells you the size of the entire pie.
Moving on to part two, large cap stocks, the stability giants.
To really wrap your head around the sheer scale of large cap stocks, just look at this number, $67.8 trillion. That is trillion with a T. That was the total market capitalization of the S&P 500 back in May of 2026. This index tracks the 500 leading publicly traded companies in the United States, which makes up roughly 80% of the entire market cap of all U.S. public companies. So when we're talking about large caps, we're talking about massive, established, household name multinational corporations.
And inside that massive trillion-dollar pool, power is heavily concentrated. We're talking about heavy hitters like Nvidia, Alphabet, Apple, Microsoft, and Amazon. Get this. Just the top 10 companies in the S&P 500 account for a whopping 38% of the entire index's weight. These are the companies generally viewed as lower risk, simply because they have entrenched market positions, massive cash reserves, and global reach. They're the ones offering steady returns and stability.
All right, part three, mid-cap stocks, the growth stage.
So mid-caps are kind of the sweet spot. They represent this transitional phase of the market. These are companies that have totally proven their business models. They aren't pure startups anymore, but they still have a ton of runway left for expansion. They offer a really nice balanced risk and reward scenario. And what's honestly thrilling about this category is that mid-caps are the crucial bridge. They are the fertile ground where many of tomorrow's dominating large-cap giants are currently being born and scaling up.
Next up, part four, small cap stocks, high growth potential. Now, the ultimate benchmark for this category is the Russell 2000 Index. It features roughly 2,000 of the smallest U.S. publicly traded securities. This right here is the startup phase of the public markets. It's high volatility but high reward. Keep in mind, some of the biggest companies in history started right here as small caps. But we have to be real, the risk is significant. According to Fidelity data from early 2026, about 41% of the companies in the Russell 2000 actually don't even generate earnings yet. So you are investing heavily in a vision of future potential, not guaranteed current profits.
Which brings us to part five, the valuation gulf, which is honestly a historic anomaly right now.
These numbers paint a pretty stark picture. Over a recent 3-year window, driven by a massive mega-cap tech rally, the large-cap S&P 500 rocketed up 31%, but over that exact same 3-year period, the small-cap Russell 2000 actually lost 6.8%. So why this massive gulf? Well, higher interest rates. You see, smaller companies rely much more heavily on lines of credit to fund their aggressive growth. When interest rates shoot up, their debt becomes incredibly expensive, eating straight into their bottom line, while those massive tech giants just fund operations from their own deep cash reserves.
But here is where things get really fascinating.
This chart from Fidelity shows the cyclical performance of U.S. small caps versus large caps going all the way back to 1929. Historically, small caps and large caps take turns outperforming each other in cycles that last about 7 years on average. The fact that large caps have been dominating for well over a decade makes this current cycle an absolute massive outlier. It's literally one of the longest stretches of large cap dominance since the Great Depression.
Let's look at part 6, the small cap opportunity, and how the odds might be shifting.
The historical data brilliantly illustrates a potential huge opportunity here. As of March 2026, U.S. small caps were in their absolute cheapest valuation quintile relative to large caps since 1990. Look at the data here. When small caps hit this incredibly cheap quintile over the past 35 years, their historical odds of outperforming large caps over the next 5 to 10 years absolutely skyrocket. We're talking hitting 79% over 5 years and a staggering 96% over 10 years.
This data perfectly backs up a compelling observation from Denise Chisholm, the director of quant market strategy over at Fidelity. She was quoted in a recent Interactive Brokers report saying, quote, "In my opinion, your risk-reward trade-off is very skewed in favor of small caps. Essentially because they've already been priced in anticipation of a recession. If the U.S. economy actually manages a soft landing, these small caps have plenty of room to recover and run."
Furthermore, there are some very specific, real-world trends acting as major tailwinds right now. First off, any potential Federal Reserve rate cuts would disproportionately help small caps by lowering the cost of all that floating rate debt they carry. Second, this whole push to reshore and localize U.S. supply chains, that heavily favors small caps since they tend to be way more domestically focused than massive global multinationals. And finally, small caps currently make up only about 4% of the overall U.S. market cap compared to a long-term historical average of 9%. Even a simple reversion back to that average would represent massive, massive growth.
Finally, part 7, investor strategy, balancing your portfolio. So what does this all mean for us? Well, smart investing isn't about just hunting for the cheapest stock price. It's about understanding the fundamental DNA of the company you're buying. Step 1, always look past the share price and check the market cap to understand the company's true size. Step 2, take a hard look at your own risk tolerance. Are you actually okay with the roller coaster volatility of companies that might not even have earnings yet? And step 3, balance your portfolio. You might totally want the steady, reliable compounding of large-cap tech giants, but as the data clearly shows, having some exposure to the heavily discounted high-growth potential of small caps could be a historic opportunity right now.
And that brings us to the end of this explainer. I want to leave you with a question to kind of examine your own strategy. Which category do you actually invest in the most right now? Large, mid, or small cap? Have you been riding that large cap wave, or are you out there hunting for value in the small caps? Let me know down in the comments below. And if you found this deep dive valuable, make sure to hit subscribe to US Infoviews for more structured, visual insights. See you next time.